Ladies and gentlemen, and welcome to this week's Let's Talk Dairy. So, as I said last week, I was hoping to talk to somebody in the NFS, in relation to the survey results that have been released for 2021. So, I suppose it's something that happens on a yearly basis, and we always probably, I suppose, in particular on the dairy side of things, it often makes the front page in terms of the headline figures. I've asked Trevor to come on today, and Trevor is one of the authors of the report, along with Emma Dillon and John Lennon and Brian Moran, and also obviously credit to the recorders that are involved as well. But I've asked Trevor to just give us a little bit of information in relation to last year's survey, what kind of forecast he can kind of give maybe for 2022. But I've also asked Trevor to actually explain a little bit about the National Farm Survey, the reason why it's done, and some of the data that goes into it and how it's actually recorded, because it's quite often misunderstood, I'd say, or there isn't a really great level of understanding of how the results are actually achieved. And many people get a bit vexed, I suppose, Trevor, is probably fair to say, about the data being released. But it is actually an EU requirement that we do gather this information. And it's actually forms an awful lot of background to a lot of the policies that are decided at government level. So the work that you do is very, very important in terms of gathering that data. So I'll hand over to you, Trevor, and thanks very much for coming on. And I'll ask people to put in questions there as we go along, and I'll put them to you as needs be, maybe, or I might hold them till the end, depending on the timing of them.
Okay, Stuart, thanks very much for that, and thanks for the invitation first to talk to everybody on the webinar this morning. You gave a great introduction there, Stuart. Just for the benefit of anyone who mightn't be aware, the National Farm Survey results for 2021 were released early last week, and they got a bit of coverage on TV and radio, and obviously in the farm media as well. Stuart asked me to say a little bit about the National Farm Survey itself and what exactly it is. And I suppose the best way to summarize it is that it is a survey of around 900 farms in Ireland that is done in a way that we can be confident from a statistical point of view that the results are representative of about 90,000 farms in Ireland. So we don't cover or claim to cover the bottom 40,000 farms in Ireland in terms of output. And, you know, those are very, very small farms. They're about 15% of the agricultural area, and they only make up about 1% of the output that's produced in agriculture. So what we talk about here represents about 99% basically of that output. So what happens essentially is the CSO gives us a list of names of farmers and their addresses at random. And we go out and we talk to the farmers involved to see whether they would be willing to participate in the survey. About half of them agree, half of them say no, and that's fair enough. It isn't for everybody. And what will happen then is that an individual, what we call farm recorder, will be assigned to that particular farmer, and we'll go out and meet him for 2 or 3 hours, maybe 2 to 3 times in the year, to collect basically all the invoices and what have you, milk check information and that, in the same way that an accountant would do, basically to set up a set of accounts. So that's the basis for it, essentially. And as Stuart said, this is done in every member state of the European Union. It's a requirement as part of EU membership, and the main basis for doing it, I suppose, is because a significant chunk of the European Union's budget is spent on the agriculture sector. So I'm going to talk, this presentation here has a lot of slides in it, and I won't be talking through all of them, don't worry about that. You can get this presentation on the Teagasc website, and I'll put a link to it maybe in the chat in a minute, Stuart, when I'm done, and people can actually go and look at the entirety of the thing if they so wish as well. So what I'm going to talk about initially is just some of the key results here, and then I'll talk specifically about dairy. So a lot of what I'm going to be talking about here is averages, and we need to keep in mind that some people will be above the average and others will be below that average. A figure that's not particularly useful at all, I suppose, is this figure for average farm income of €34,000, because that averages across dairy dry stock and tillage. And if you look at the average income levels that are achieved in each of those systems, you'll see that the income levels in dry stock, cattle udder, which is largely finishers, cattle rearing, and in sheep are well below that average figure down there. And equally, the tillage income and the dairy income are a good deal above it. I suppose the main summary point for 2021 is that incomes went up across all of these systems by anything from 6% in the case of finishers to as much as 77% in the case of tillage farmers. Tillage farmers benefited from really high prices and good yields last year. And as we'll see in a while here, the dairy income story was quite positive as well. What you can see here in the chart, in particular, I suppose, is there is a definite upward trend in terms of dairy income since quota elimination and the expansion in milk production that has come with that. So if I go looking specifically at some dairy results here, just to give you some headline trends in terms of what has been happening in recent years, because the survey extends all the way back to 1973, so we have a long series of data. Some headline numbers, I suppose. Average cow herd size now is up to about 90 cows at this stage, and obviously that varies. That average varies regionally, and we have quite an amount of farms now that have over 100 cows in the survey. Total livestock units on the average farm about 132. Average milk yield about 12,100 litres per hectare now, or thinking it in terms of per cow, about 5,750. But you can see there that we have an upward trend through the post-quota period in terms of milk yield. Not as strong as the trend in the increase in total cow numbers, but still we're seeing a contribution from both yield and increased cow numbers to the total increase in milk production. The average area of a dairy farm in our preliminary data is down slightly on last year, and all I'll say about that is that these are preliminary numbers, and we have a few big farms yet that have yet to report for our final figures. So that slight decrease you see here probably won't be in our final figures, but you're up around 65 hectares now as your average dairy farm size at this stage. And stocking rates seem to be relatively stable over the last 2 years, in and around the kind of 2.1 livestock units per hectare type of figure on dairy farms. We look at the progression of income in recent years, and again, these are average figures, just keep that in mind. We see a sizable jump in 21, going from 79,000 up to 97,000 as the average. I suppose people will only be too well aware of the factors behind that. We had a large increase in milk price in 2021 of the order of about 14 or 15%. At the national level, milk production pushed on as well by about another 5 or 6%. And while we had an increase in costs in 2021, it wasn't that substantial because the kind of inflationary pressures on the input side were only really starting to kick off last year, and I suppose they were starting to affect fuel prices and fertilizer prices in the second half of the year, and feed as well as the year progressed. But really, those cost pressures are being felt more upfront, I suppose, in 2022. So average income in 2021 was €97,000, which I think is up about 23% on the 2020 level. So that's the highest figure we've reported. Now, these are nominal figures, so they don't take into account inflation, and inflation has been very low up until very recently. So I think in terms of future figures, we will have to factor in inflation and in the way that we begin to report these numbers. What else do I want to say to you? If you look at data on concentrate feed use, we can see these kind of charts here are quite complicated to interpret, but what we have here is we have the population divided up according to stocking rate. So you have farms with 0 to 1.5 livestock units, 1.5 to 2, and over 2 livestock units per hectare. And we don't see the line here in the middle here is the median, which is quite close enough to the average level of feed use per farm. So a little over a ton per farm, or sorry, per cow is the median feed use. The average figure at this stage is probably about 12 to 1300 kg per cow. So that has been following an upward trend really since quota elimination. I think we've added about 200 kg to the average feed of a dairy cow in recent years. What this chart shows you here is that there's a range of feed use. So inside these boxes here, basically you have 50% of the farms. So we can see here like that 50% of, we'll take the over 2 livestock units example for the purposes of this example here. So we can see here that in 2020, for example, the 50% of dairy farms had feed use per cow in and around 800 to about 1400 kg. And we see that that figure was slightly narrower, we'll say, in 2021. So it was probably more like between 900 and 1400 for most of them. So yeah, what else do I want to say to you about this?
I suppose, Trevor, is the thing to point out there then as well is that you have that range outside of the box. So the other 50% are going from anywhere from 200 kilos up to 2 tons.
Oh, they are.
As well.
They are.
For people to interpret the box plots like.
That's it, yeah. These lines here, as they extend out here, will show you other farms that have reported in the system, and some of the ones out at the very extremes could have had something very peculiar happening to them. So I wouldn't take too much notice of the very end points. But it is worth noting, as you say, Stuart, like that, as we come down here, for example, you'll have examples of farms with 500-600 kg per cow, and equally up at the other extreme, particularly farms in the west now might have, figures heading higher again than the averages I was talking about there.
That's interesting to look at from my perspective, is that there isn't a huge difference depending on the stocking rate.
No, there isn't. And what you see as well, even when you look at that regionally, is you don't see a huge variation regionally either in the amount of feed use per cow. But where you do see a difference, Stuart, is in the amount of milk that's produced. So, it's that extra grass that farmers get into the cows in, we'll say, the southern and eastern regions compared to the northern and western part of the country, that tends to make the bit of a difference. I mean, I think some people imagine, all right, that feed use is low in the south and it's high generally in the north as you go further north, but it's more to do ultimately really with the amount of grass that's getting into the cow, that is pushing those higher yield figures, we'll say, that you'd get typically in the southern and eastern regions. Now, what else do I want to say here? Just some data in terms of production costs. So you can see we did have a sizable enough increase in production costs in 2021. At the same time, it'll pale into comparison with the type of increases that we'll see in 2022. I don't know whether at this point, Stuart, you want me to start talking a little bit about 22?
Yeah, I suppose in the cost point of view, it's no harm to start digging into it.
But yeah, we can see here, for example, just even for 21, that there's that bit of an increase in production costs. So, we had about a 10 grand increase in production costs, total production costs. Ultimately, 15 grand increase in production costs ultimately in 2021. Here you can see a kind of a decomposition of those costs, and this isn't the easiest chart for me because I'm colorblind. So so if you think it's hard to interpret yourself, then spare a thought to me. But you can kind of follow here, you know, for your average farm, you know, the typical structure of the costs that you'll see on these farms. And people tend to pick out specific numbers and say, oh, that doesn't really correspond to my situation. But that just reflects the fact that these are average figures. You know, one that comes up quite frequently is people will say, Jesus, your figure for hired labor there is very small. But what you have to keep in mind in these average figures is that they're averages of farms that would have hired labor and those that would have no hired labor at all. So that tends to dilute, we'll say, the contribution of hired labor to costs when you average out across farms. One of the things we could do potentially is to produce a set of results for farms that do have hired labor and those that actually don't, and that might give a better reflection. I think that figure actually may have even been quoted in the Farmers Journal article that was written on this last week.
But very crudely though, Trevor, like you can say with those averages, like for the larger farms there, potentially they have somewhere in the region of 50 to 52,000, because obviously at the other end of the scale you have someone that has a zero labour cost there. So
yes, yeah, that's it. That's it, Stuart. I mean, we would regularly get people, you know, saying I've two lads working for me, you know, my hard labour costs are a very significant chunk of my costs, and you just kind of have to say that in the end these are average figures, and they're a simplification for the purposes of presenting the results. So, you know, we would never be encouraging anybody to be hawking around these average numbers as being representative of all dairy farms, you know.
Yeah.
So yeah, just thinking about 2022. So, and I don't have slides about 2022 because it's an evolving situation. We did a review of it there in April, and we'll do another review of it next month because, as I say, it's a dynamic situation. We produced an outlook for 2022 back last December, and obviously that had to go into the bin as the war started in Ukraine. So based on our revised assessment, obviously we have, I suppose, two key things in respect of the dairy sector. Number one is that milk prices, which are already very high, dairy commodity prices, we'll say anyway, which were already very high at the back end of last year. 6 months ago, the expectation is that they'd gradually fall back over the course of 2022, and that milk price would be high in the early part of 22, and then it would ease back as the year progressed. Of course, circumstances have changed since then. Costs of production have increased very substantially, and the outlook for dairy commodity prices became a lot more positive for 2022, and even expectations out into the early part of next year seem to be very positive as well. And essentially the reasoning for that is that the growth in milk production globally in 2022 is expected to be, you know, very, very small. So that means people will be out there chasing dairy products, and that's good for the price of dairy products as a result. So, I mean, cost of production, our assessment in April suggested that cost of production, that's total cost of production now, including overhead costs for dairy farms in Ireland, on average could be up about 30% in 2022. And that would be taking your cost per litre, your average cost per litre, up to around 34 cent or thereabouts. So when you factor in where milk prices are now, there's still a very healthy margin in there. So our assessment in April was that dairy incomes for 22 would pretty much hold, with the potential for them to actually even increase in 22 compared to 21. And then the one issue we did flag all right was scenarios where people had significant volumes of milk tied up in fixed milk price contracts that were set at prices that were a good bit lower than what's available directly from the market at present. So I think overall, in spite of all the increase in production costs that has taken place, that crazy price for fertilizer, the fact that feed prices are up a chunk, and that cost of fuel, cost of contracting, all of these things are up as well. That the buoyancy in the dairy market at the moment is so good that my assessment at this point anyway is that there isn't a reason to expect incomes to fall in 2022, and they may well even be higher in 22 than they were in 21. But as I say, we'll come back next month and do another review of that, and we will publish it. One of the things we'll probably see in that is feed prices have moved down another bit. At the same time, the dairy situation remains very, very healthy, and I don't think there's any reason to expect at this point that we'll see any significant change in milk prices over the next 6 to 9 months. So I might stop at that point, Stuart, and open it up for a few questions if there are questions.
Yeah, so I suppose you said an interesting thing there yesterday as well, Trevor. I suppose a 20% increase in milk price covers a 30% increase in cost. Can you explain how that works?
Yeah, well, you need to keep in mind that your cost of production are lower than your total cost of production are lower than your output price, basically. If you want to look at this on a cent per litre basis, for example, the difference obviously is your net margin, and so you're applying basically a smaller percentage increase to a bigger number in the case of output prices,
okay,
to maintain your margin. So in other words, to maintain whatever, say 12-cent margin or something of that order, doesn't require that you have the same percentage increase in your milk price as you would in your production costs. Now, if you're a beef producer, you'll be in a very different game, because you probably have zero net margin. So you need your output price to go up by as much as your production costs to maintain your margin in that situation. But it's just a kind of that's just a kind of a statistical thing or mathematical kind of thing that mightn't occur to you, because your output price or your milk price is a bigger number than your production costs. So the percentage increase in one doesn't have to be the same as the other to maintain your margin in cent per litre terms.
And in terms of the other figures that I often look at is the debt associated with dairy farms. So obviously higher return in enterprise, but obviously higher debt associated with it as well. Have you seen, is that beginning to taper off now, since we'll say the surge in relation to the development post-quota is probably a lot of it, the work is done, or well, the vast majority of it is done. Is the debt level beginning to drop on the dairy farms now?
These are new numbers, Stuart. They're only there a week or so, so I can't say I've looked into them in detail to be able to answer that question for you. And that's just to prove that you didn't give me all the questions in advance. But I'll look into it, and I'll reply to you by email on it. And you can circulate that or mention it in your next webinar maybe.
Yeah, and the other one I suppose that we were discussing yesterday then as well is maybe just how the BPS is evolving next year into breaking up into 3 different schemes, we'll say, and how the figure that I suppose while people often say that it's not a significant proportion, it's still averaging out there at 18% of the dairy income from the figures that I saw anyway, and like that's still a fifth of a person's income. So the subsidies as such still have a role to play for dairy farmers too, don't they?
Oh, they do, and we would always be saying as well, like that are an important income stabilizer, particularly in years, say now, where milk price and costs would move against you, and your net margin would contract. You have that buffer at least of your single farm payment, which is a number that doesn't particularly change year over year, excepting some of the changes that were made in recent years, which were, for most farmers anyway, not that significant, but that's a kind of that's a guaranteed chunk of income, we'll say, that's coming in to begin with. Yeah, but it's it's up there at what is it, about €20,000, that kind of territory, when you take into account all of the supports that are available to your average dairy farm. The new cap, I suppose, the thing that will be of interest, particularly from dairy farmers, is the introduction of these so-called eco schemes, which are, a range of different actions that you need to kind of cherry pick from and perform if you want to receive payment under them. So what we called the basic payment, I suppose, or its equivalent, is now being called the BIS, and that's now a smaller chunk of the total support than it used to be. So if you want to get access to these eco scheme payments, you have to do that bit more from an environmental point of view. And I suppose what's not clear at the moment is whether dairy farmers will sign up en masse, whether all 15,000 odd dairy farmers will say, that's grand, I'll pick a few measures there, and I'll go off and do that, and I'll collect the eco scheme component of the support as well. Some farmers might be looking at it and saying, is this worth all the hassle? The results we have for 2021 here show that there's about €1,100 per hectare of income on the average dairy farm. So some people might be looking at the eco scheme money and saying, is it more hassle than it's worth to apply for it? The government perspective on it is very much that we want every farmer in, if at all possible. And that's the EU perspective as well. So much so that if in year one, not every farmer is signed up to the eco schemes, there may be tweaking of the eco schemes to some extent to try to ensure that in subsequent years everybody does go in, because one of the consequences ultimately of farmers not signing up for the eco scheme is that eventually the money that was allocated to those farmers, which they won't get, actually will just go back to Brussels. And Brussels would much prefer that the money was spent and that the actions would be taken by farmers. So they're trying to avoid an outcome, I suppose, where significant number of farmers opt out of the eco scheme dimension of this new cap. They want all farmers in, if at all possible, and the money spent, basically. So, but it will be interesting, there's a few people kind of humming and hawing about whether this thing is significantly attractive for dairy farmers, given the very high level of profitability that's there at the moment. The economist Alan Matthews, I think, wrote an article along those lines of maybe a month or 6 weeks ago, and I think that was in the Farming Independent, if I remember well. So he was wondering the same thing, basically, is dairy so profitable now that the eco scheme money mightn't be worth chasing, as far as some dairy farmers might be concerned.
I suppose, again, like everything, and we have to think of the bigger picture too, though, don't we? Because I suppose the challenge with the eco schemes, Trevor, that I'd see it, is that an awful lot of the farms are actually already going to be doing some of these things as part of derogation, so they won't actually be options for them.
Yeah,
the actual table of choices becomes very small then, and it actually, you're moving into kind of deciding to put a bit of land back into forestry or do this or do that, which is kind of nearly contrary to what people have been doing all the last number of years, is trying to get all land available for grazing, really.
I think we need to think about it as well from a political point of view. Like, it would be bad PR now, I would say, in the next few years, if we saw, headlines saying that a significant percentage of dairy farmers had chosen not to avail of the eco scheme, because that would be, I suppose, be sending out a message about dairy that really we wouldn't want sent out there to the wider world, So I think that will be a consideration as well. But as I say, the scope and, some of the stuff now that's happening with this new cap is kind of experimental, and there's scope in there to kind of tweak things around in terms of how those schemes might operate, with a view to try and pull in as many farmers as possible, get them to perform environmental actions, and in return ensure that the money that's been put aside for those actions actually does get spent in each of the member states. Like, I mean, the as I was saying there a while ago, like the commission, a good result for the commission would be that all the money was spent on as many farmers as possible, and this idea that money would just come back to them and be sitting there and actions not being taken on some farms isn't one that they particularly want to see as an outcome.
Okay. And I have two final questions for you then.
Okay.
The Q&A system must be broken because Patrick last week didn't get any questions either,
Right.
or else I'm shocked. So the first one is probably just, we spoke an awful lot about volatility in the pre-quarter removal period. And while there's been a small little bit of it there, like you can see from the figures that you're showing there that it's a fairly buoyant industry now. Is there anything behind that, or is it just luck that we're on an upward trajectory? Is there a downturn going to come at some point? Like this, we still talk about volatility, but like one of the things I would have seen is that I think since quarter removal, people were free to drive on at every stage of the year, and that has been significantly important to people because I just don't see the crisis issues with finances that we used to see, because you could kind of farm your way out of trouble if you were in a bit of trouble. But it's just interesting that, you know, it's upwards. I know now we got a dip there from 17 back into 18, but that was probably driven by a number of factors, including the drought, obviously. But we're upwards there. And to echo what you said as well, I just saw something there this morning in terms of the global milk supply is well back, and prices will stay high for the, like as you said, 6 to 9 months. And generally people don't want to commit to more than 3 months most of the time when we talk about prices. Like, so is the volatility thing kind of done, or what's your thinking on it?
Well, I think you need to, with all these things, you need to think about them from the two sides. You need to think about them from the supply side or the production side, in other words, and you need to think about it from the demand side or the consumption side. And I suppose it's easier to think about the production side from a farmer's perspective, I suppose. And if you look at what has happened, we'll say in the last 5 or 6 years in the 3 big exporting regions in terms of dairy, 3 big exporting regions are New Zealand, ourselves in the European Union, and the US. And like, if you look at the numbers for New Zealand, you'll see that they've flatlined, they've topped out now. They've had very little change in their milk production in recent years. And, you know, the increase in milk production each year in New Zealand used to be a significant contributor to the growth in global milk production every year. So they've kind of, it looks like plateaued. They've got a lot of environmental pressures and politics around that, more than here in Ireland. It seems like they're more keen now to try and get up the value chain in terms of not so much fixating on producing more milk, but basically trying to produce higher value dairy products and add to the milk price, as opposed to just doing more volume. Here in the EU, the situation is, I suppose, a mixed one, because you have the likes of ourselves who've expanded very strongly. You've had a few other member states who've expanded as well. Some have stayed relatively flat since quotas were removed. And then you have examples like the Netherlands, where things are being pushed backwards due to, again, environmental pressures. So the growth in milk production here in the EU is lower, I suppose, of late than would have been the case previously. And then in the US, you know, their growth was quite strong, but it's difficult to understate how messed up the US is now as well in terms of its labor market. It seems I think it seems to be after the whole COVID situation. But like, you know, just as an example, I was out in Missouri a few weeks ago, like, and the hotel I was staying in, you had to actually ask specifically to have your room cleaned, because they were trying to cut back on labor there. You know, there's a significant labor shortage right through the US economy now, a lot of logistical problems. So even though we have very high milk prices, it seems like it's difficult to get more milk production in place because of things like labor shortages and other kind of logistical problems involved in transporting milk, getting it processed, and what have you. So we're in a kind of strange situation at the moment, Stuart, where milk prices are very, very high. Profitability in a lot of places is quite good, but it doesn't seem like we're going to get a strong increase in milk production in the short term anyway, at least. So that's kind of created the recipe for the very high prices we have on the production side. And then if you look at the demand side, everyone will still say to you how important China is. And one thing I would say about all these people analysing the dairy market is they probably know a lot less about the demand side than they do about the production side. And, you know, China is a hugely important player in terms of absorbing particularly a lot of milk powders. And people have a hard time trying to interpret what happens next in terms of the level of demand for dairy products from China. But like, you know, if you were looking for potential negatives down the line, you know, if the demand growth eased off for dairy products eased off in China, then that would ease the pressure globally to get more milk produced, and you'd see milk prices starting to drop back then in that circumstance. But the situation at the moment is that there's very strong demand out there for more milk, and it isn't obvious where more milk is going to come from at the global level right now, because the three big players in terms of milk production globally, or milk exports, I should say, really, New Zealand, the EU, and US are struggling kind of to boost milk production.
Yeah, okay. And the Q&As after coming to life there all of a sudden, anyway. So there's and this question is actually kind of tied into the last question I was going to ask you anyway. So it's a small. It always aggravates people. Like, I know I always get text messages from some of my friends that are farming there, and they see the front page of the journal after the survey is launched. The results of the survey are produced, you know. And so the question in from John Cusson is, if a proper labour cost was applied to the income outcomes, how good would the figures be in reality? So I suppose it's just that headline 97,000. People see that maybe if they're wandering around the shop and they're looking at John as they're at mass on a Sunday, then saying, "Geez, he made 97,000 last year, and he doing well," basically, kind of situation. So what we'll say, when you actually cost in the labour, we'll say, seeing as John asked the question, if you put a value on John's own labour there, what's the true reality of the survey like? Yeah.
I mean, this does come up a lot. You know, I didn't even look at what the question was, and once you started to describe what it was, I could guess. Listen, all I can say about it is, you know, we have to report these figures to the EU, to the European Commission. And the way we do these calculations is actually set out for us. Like, we are required to include hired labour, but we're required to exclude own labour, as we call it, from the production costs. So that basically the income figure that's calculated at the end of the day is supposed to cover the own labour contribution and the return, basically, to any money that's invested in the farm. That's the thinking on it, like, and it's the same for all the other systems. Now, if you were to go in, obviously, and cost the labour, I think we have 1.4 labour units, I think, on the average dairy farm. A labour unit is about 1,800 hours of work from memory. So yeah, that would substantially reduce the income level that would be shown up in these systems. But you need to keep in mind as well, if you were to do that for all the other enterprises, they'd, you know, where would they end up? You know, the other systems have production costs associated with the own labour as well, and so you'd be pushing some of those guys back into negative numbers almost at that stage if you were to do that. And, you know, I suppose in the broader question, I'm not so sure how sympathetic Joe Public would be to the kind of the nuance of the income definition inclusive, we'll say, or exclusive of the own neighbour, because their argumentation will be, well, the money's still going to the same household in the end, whether you define it net or inclusive of the own neighbour cost, But like, I mean, there's no denying, even if you were to go back and cost it that way, there is no denying like that there has been a very substantial increase in dairy farm income in recent years. And it's a very positive story, I think, to be telling. Some farmers are not so happy about it because I suppose some people will be beginning to get concerned about whether, the future of the single farm payment for dairy farmers and what have you would then be starting to be increasingly questioned. Looking at that 97,000 figure there, you might be saying, why are we paying somebody 20,000 euro who is already earning 77,000 euro from the marketplace? So that argument could be put forward by some people. Now, the reality is that for all the change that has happened in the Common Agricultural Policy over the last 15, 20 years, there hasn't been a very substantial change in the single farm payment available to dairy farmers in general. So that might be a false worry to some extent, if it's a worry that's there on the part of some farmers. But it's a definitional approach. We don't decide how to do these calculations. We're following the same system that every member state has to follow in how we report these income figures, and we have in the past, and we do actually when we, later in the summer there now, we'll do a fact sheet which will show the kind of cost per litre numbers when we get to our finalised figures for the numbers we're looking at here today. In the next few months, we'll do what's called an enterprise fact sheet, which basically breaks things down on a cent per litre basis. And we do actually mention in that document, as far as I remember, that the cost doesn't include the own labour. And if you were to put a cost on the own labour, how significant it would be. Again, it depends on what price are you going to pay yourself an hour, for that work.
That's the challenge with that all the time, is like people will have a different valuation on their time. And actually saw something there from the European dairy farmers, even that Irish farmers are actually inclined to pay less on an hourly basis than their European counterparts, actually. But I suppose you do pick up a share of it too, though, Trevor, in the household survey stuff that you are doing, don't you, in terms of how much it's costing to run a house and so forth as well?
I mean, we don't generally publish the figures, but like we do pick up information on other sources of household income. Let's say, like, we don't generally publish that. So like the data we go public with is exclusively the data coming into the house, or the income coming into the household relates to the agricultural activity.
Yeah, okay. But we'll say the sustainability piece then, like, and I think Emma's going to cover that with Emma Louise now one of these days on the on the podcast as well. But that does that kind of picks up whether farms are viable or not. So it's not like we're just throwing out headline figures. There are a proportion of farms in that survey that are maybe a little bit vulnerable potentially.
Yeah, and that's important. It's an important thing to say, because one of the first remarks I made was that these are average figures I'll be talking about now. And if you go through the 300 farms that we have in the National Farm Survey, and we don't ever throw up figures for an individual farm in terms of public discussion. But if you were to go through those numbers, you will see like that there are some dairy farms even now, in spite of quota removal and high milk prices, that are recording income levels that would be much closer to what you might be achieving on, I suppose the better performing dry stock systems. They're not very low incomes, but they're a hell of a lot lower than what this 97,000 figure would suggest on some dairy farms.
Okay, so look, I think I'll leave you go because I know I have a meeting to get to. So thanks for coming on. You might send me on the link for that, and I might tweet it out there later, because there's some great information there. And that Power BI methodology that you use is actually very interesting for it to actually move across figures like you were doing there in the presentation, and it could be very interesting for people if they want to take a look at it. So thanks for coming on, Trevor, and thanks to you and your team, for putting the data together. I find it very interesting anyway, and I hope people got something from it. And we'll talk to you again maybe at a later stage in the year again after you've the new forecast for 2023 done, maybe.
We've a bit of a job ahead of us, I think, Stuart, because there's so much going on at the moment. Trying to capture it all is going to be a challenge. But thanks again for the invite, and I hope people found it useful.
Okay, thanks very much. So next week I'll be talking to James Dunn, who's just going to be giving us a rundown on some of the research that's been done in Ballyhaise in advance of the Ballyhaise Open Day. So I look forward to talking to you next week. In the meantime, stay safe, and hopefully the rain comes, because we're looking for it in the south. Anyway, I'm not so sure you're looking for it in the west, Trevor, but thanks very much for coming on, and we'll talk to you next week.